All right, we're hot.
All right. Janice, did you want to do a quick little intro? I have to jump off.
Sure.
Thank you.
Yes. Hello, Darlene.
Hi, Janice.
Hi. So this is the amazing Darlene Hashem with RBC.
Live. It's live.
Yeah, exactly. And she is incredibly knowledgeable about all things mortgage, knows when to pull people in if she has additional questions, but is able to answer pretty much any question I've thrown at her and Todd has thrown at her from a construction point of view. So she is amazing when it comes to communicating information as well to buyers, and to sellers as well, but specifically to buyers to be able to help them understand the whole process, no matter where they're at in their home search journey. So we're very thankful, Darlene, for you to join us today and to talk about draw mortgages and some of the ins and outs and complexities of that one.
They're fun. They're lots of fun.
Yeah, they are. So we will let you take it away.
Okay, guys. Well, thank you for joining. Feel free to interrupt me if you have any questions. I apologize. I really don't have any aids, like any slides or anything to share with you. So you're just going to have to watch me talk throughout the morning presentation, but feel free to ask some questions. When I meet with clients one-on-one, it's a little bit like Pictionary. I take a piece of paper and I start writing out for them. Here's how it works. Here's your land. Here's the mortgage. Here's how the draws work. It's just I really don't have a tool to do that here. So I'll just kind of start talking in general about construction mortgages and some of the terminology, because as a realtor, I expect what's happening is you're having clients say to you, oh, I want to buy a new home, or I want to, or what I often get is I need a construction mortgage. So when I hear that, I don't always take it at face value that they know what construction mortgage means in our world. So my first question is, well, tell me about the type of construction you're looking at. And often what they want to do is buy a turnkey construction home, which is not a draw mortgage. So a turnkey construction home is very straightforward. It's very much just like you're buying a resale home, only the home is new. And what in the banking world, what turnkey construction means is it's one price for the client. So the builder owns the land, the builder builds the home. Sometimes the client can pick the lot. Sometimes the client can pick finishings in the home if it's not done yet. But at the end of the day, it's one price. So if that's $400,000 and it's closing January 30th, their mortgage is advanced on January 30th, just like a regular mortgage. So that's turnkey construction, but we don't always expect clients to know those terms. So it's good to get that clarity. I would expect you guys probably do more of that than anything, although I know you do get involved with some construction draw mortgages as well. So construction draw mortgages work quite a bit differently, and it's a little more difficult to qualify for a construction draw mortgage. I don't word it that way to the client, but I just want you guys to know, because sometimes we have first-time home buyers, and our first-time home buyer may be a plumber, and he has great dreams of building his own home because he thinks that he can save some money doing it. But in order to qualify to do that, Janice is laughing because it's not cheaper to build your own home, as we all know, especially with the cost of materials right now. COVID's really made a change that way, and also the lack of some materials. So I always talk to clients and say, you need to have good tradespeople. You need to be able to make sure that you can get those resources. If you want to be your own general contractor, you don't want to be halfway through a home and then you can't get people to come in and drywall and it's holding up the progress of the home. So talking about construction mortgages, there's two types of construction mortgages. We'll start with the first one. It's a little more straightforward than the second. So one is where I'll call my client John Smith because that's such an original name. So John is, He owns land, he wants to buy land, and he's hiring a builder to build him a home on that land. That is a contract construction price. And then we'll use Alex, because Alex is on the line, as another client. And Alex is handy and thinks that he wants to build his own home and he wants to be his own general contractor. So what that would mean is Alex would buy his land or get some financing for the land. He would start to get all of his quotes to build the home, pull it all together, and come in and say, here's what my numbers are adding up to. That's called a self-build construction. So really two types of construction, builder by contract and self-build construction. And again, within those two silos, one is easier to get approval for than the other. And I'm sure you can guess which one's easier to get approval for. The one with a reputable builder, because the costs tend to come in a little more exact. So often the first hurdle is clients need to buy the land. So they can sell a home, use their equity, buy the land. If they have equity in a current home, enough that they can refinance it, take money out of their current home, buy the land, and all of that works in their debt service ratio with their new mortgage, that's also another option for people buying land. And the third option is they have to borrow some money to buy the land. So you can't actually finance just land as a mortgage. You have to do it as a line of credit. And there are limits that you can get on a line of credit. You still need a down payment. So that's often an obstacle that people run into. They're like, I need to borrow money to buy land, which you can do, but you still need to have some of your own equity. You still need to have 5% regardless. And we can do some examples at the end of this where maybe some of these numbers will make a little more sense. So the first thing is we talk to the client about how are they going to finance the land. And I would suggest as a realtor, if you ever have a client that says to you, I'm looking for land, I want to buy land, tell them to talk to their bank about a construction mortgage before they purchase that land. Because I've seen a few clients buy the land, then come in and try to work out how a construction mortgage is going to work and realize that maybe they can't get approved for the amount that they want to be approved for. And now they're sitting on land, which maybe isn't a bad thing, but it's not their original plan. So once they have the land, and presumably they're meeting with builders, they want to work with a reputable builder that's going to work with them to make this process run smoothly. They want to make sure that the builder has a new home warranty in place. They sit down with the builder, they talk about their plans, they talk about their design, they need to narrow down that so that they can narrow down the cost, of course. And then they would eventually sign a contract with that builder. So I always say, we are meeting every step of the way. We're meeting for the pre-approval. Then we want to meet when you've had your first conversation with the builder. Is your cost coming in at $320,000 or is your cost coming in at $400,000? And let's see if that works with some of the numbers that we discussed before they actually sign on the dotted line. Then if it looks like the numbers will work, then they sign that contract with the builder, and that's when we send their application off for approval. For construction mortgages, we always need an appraisal. So basically, we look at the value of the land, we look at the cost of construction, that gives us the total value of the home. Then we show what the client has for equity for their down payment. If they own the land outright, the land can be their down payment. So if Alex bought land 3 years ago for $50,000 and he had a little bit of a line of credit, but he paid that off and he now owns that land free and clear, then that land is now his down payment. So he doesn't necessarily need another 5%. Any questions so far?
Or if it's gifted to you, given to you by your parents, whatever.
Exactly.
That's your down payment. Yeah.
Yeah. Which is often the case. Sometimes, people will subdivide a parcel of land and say, I want my son to have this, my daughter to have this, and the parents live further down the road and they all live in similar areas, or land is just gifted. As long as the deed is in the client's name and it's owned by them, then yes, that is an asset and that's their equity when they're getting a mortgage. If a client buys land and builds within 12 months, then what we use as value for the land is what their purchase price is. If a client is gifted land or they bought land years ago and maybe they paid $50,000 for it, but they know the value has gone up, then what we can use for the value of the land is what the appraiser indicates the value of the land is. So that can sometimes be beneficial for people. So they can buy the land, sit on it for a few years, let the value go up, because that's giving them more equity in their project, which can sometimes be the difference between, is their mortgage high ratio or is it conventional? Because if the value of that land is 20% of the overall build, then they can have a conventional mortgage and not have to pay CMHC fees. Because you guys know that with less than 20% down payment, the mortgage is CMHC insured. So once let's say the mortgage is approved, and I'm going to use an example. I'm going to do easy math, and I'm going to say the value of the land is $80,000, which is pretty reasonable, although within HRM it's probably going to be higher. The cost of construction is $320,000, and I can pull up an example here in a minute and show you. So the overall value of the home when it's completed will probably come out to around $400,000. So that becomes the value. The down payment of $80,000 is the land. The cost of construction is $320,000, and because the $80,000 is the 20% needed, the mortgage is $320,000. So the way the funds get dispersed by the bank is in a series of draws. We used to do 4 draws on a construction mortgage. About 2 years ago, we increased it so we can now do 5 draws on a construction mortgage. And that makes it a lot easier on the client because we're dispersing money more often. I don't know if any of you have had clients that have told you horror stories about building homes, but I hear it all the time. Clients will come to me and say, oh, I had a horrible experience, or, they're just a little bit nervous about it. I think one of the things that leads to that is that the draw system is not explained properly to clients. So I'll explain it to you the way I would to my client. And I don't try to scare clients, but I also never want them coming back and saying, oh, I had no idea that this was going to happen. So the way the banks will disperse their draws is not always based on what the builder wants to be paid at a certain time. We have to base it on what the appraiser is telling us the cost to complete the home is. So the calculation is actually what their mortgage amount is, less anything we've advanced, less whatever the appraiser tells us at various stages the cost to complete the home is. So a lot of building contracts that I see, so I'm using the example of 320, the builder may write up a contract and say, I want 4 payments of $80,000 each at this stage at 4 times during the process. So I then explain to the client, that is your contract with the builder. So by signing that, you're committing to the builder that you will pay that during those timeframes. It's not our commitment to you that we'll pay those funds at those timeframes. We have to pay based on what our reports are showing. So there is often, always, a shortfall between what the builder wants at certain draws and what the bank is advancing in a draw. And that's where it can become stressful for clients, but only if they're not prepared for it. So I always tell clients, if you have assets, great. If you have liquid assets, they will use some of their liquid assets, because some people might have $100,000 sitting in the bank account from the sale of their last home, and they want to put that into the construction project, and they're only mortgaging 220, so they're going to use some of their funds for the shortfall. The majority of people wouldn't have that, so we need to get a line of credit set up for them to use. So probably a $40,000 or $50,000 line of credit. So if there's a shortfall between what we can advance and what your builder wants, they can pay that. So if the builder wants $80,000 and we can only advance $56,000 on the first draw. Oh, my screen just went blank. Everyone's still there? Okay.
Yep.
Okay. And if the builder wants $56,000 on the first draw, then the client's going to have to come up with the difference through their savings or their line of credit. Now, I will say most builders, I know Todd does this all the time, when they know you have a construction mortgage approved with a reputable bank, a lot of them are willing to wait. They're like, well, how much is your draw? Well, my draw is 56. I want an 80. Okay. And because we can do 5 of them, we can advance money quickly if the building process is working quickly. So I also always tell my clients, have a conversation with your builder and ask them if they're okay waiting for the funds that the bank can disperse. 90% of the time they are. 10% of the time they're going to say, no, I need to pay my guys and I need that money. So that's where the client needs to have a backup through a line of credit or their own assets. So first draw usually comes, well, has to come. The foundation has to be in and it has to be ready for backfill. So that's the first draw. Then they can do 4 more draws. So it can be at any of the stages. We know the first one is during foundation. We know the end one is when the home is complete. In the middle, you're probably going to have a draw when the framing is done and the roof is on. Then there's a lot of work that takes place between that roof tight stage and the completion stage. There's plumbing, electrical, drywall is a big stage, heating, insulation, you know, so anywhere in there or when the other draws can occur. Any questions so far? We can look at an example at the end and that might trigger a question for you. Okay, so have you guys heard of something called mechanics lien holdback?
Yeah.
Yeah, do you want me to explain what that means?
A little bit more.
Okay, so when I started the conversation, I said sometimes it's a little bit harder to qualify for a construction mortgage. There's 2 reasons for that. One is we need to show that you have more assets, more cash flow, because no one wants the build to get partway through and the clients can't afford to finish building. We need to make sure they have some additional funds for things such as mechanics lien holdback. So mechanics lien holdback is provincial legislation, every province has it, that requires your lawyer, because your lawyer is the one handling the mortgage draws and the funds being advanced from the bank. They'll pay the builder for you or the builder lawyer. But during a construction mortgage process, the lawyer is obligated to hold back 10% of every draw until 60 days after closing, just in case a supplier or a subtrade person comes out and puts a lien on the property. It's to protect everyone. So in my earlier example, if your mortgage is $320,000, that's $32,000 that you could be short until 60 days after closing. So when I'm qualifying a client, I need to show that you have the ability to fund that $32,000. If you have it in savings, great. If you don't have it in savings, I need to show that you can use your line of credit for the mechanics lien holdback if your builder is insisting on getting paid. If I need to show that you have a line of credit to use for the lien holdback, I also need to add a payment in on that line of credit. So I need to take 3% of $32,000 and build that into your debt service ratio, which is a payment of $960 a month. So that's where it can become harder to qualify. Now, there is a bit of a way around this. And one way around it is if you work with a builder, and I know Todd will do this for clients, he will indicate by a letter that we present. I send my client a letter and I say, if your builder will sign this letter, which basically is saying they're willing to wait for that 10% until 60 days after closing, then I don't have to prove that my client has the resource for that 10%. Does that make sense?
Mm-hmm.
So if your first draw on a construction mortgage is $60,000, then $6,000 is held back in the trust account at the lawyer's office, and you only see the difference of $4,000. So every draw you're going to be a little bit short. So that can often be a bit of a hurdle for clients. We talked a bit about self-build. If a client wants to build a home without a reputable contractor and they want to be their own general contractor and they want to hire all of the sub-trades, we also have to show that you have another 10%. So you would definitely need 10% for the mechanic's lien holdback because there is no builder involved that's going to sign that letter. And you also need to have 10% for overrun, because you're getting quotes from sometimes 10, 15 different people. And, they're writing up a quote and saying $8,000 for drywall or $20,000 for excavating or whatever the cost may be. Sometimes those quotes are not enough. So we need to build in a contingency of 10% of the cost of construction. Mm-hmm. So if you wanted to do a self-build construction and your costs were $320,000 is the cost of construction, we would have to show that you had $64,000, 10% for mechanics lien holdback, 10% for overruns, in order to get you approved for that mortgage. We also need to comment on what your experience is building a home. You need to have some experience with build construction. So during the construction process, as funds get advanced, clients are paying interest only on those funds until the final draw, and clients now have 18 months to complete their home. It used to be 1 year, and we just changed it in July. We extended it. So during the building process, if we've advanced $100,000, you're just paying interest only on the $100,000 until the home is complete. And when the home is complete, then it goes into repayment.
Darlene, how often do you have clients that are building their own home?
You mean self-build, Janice? Yeah. Not as often here in HRM. It seems to happen more in rural areas. I'm not sure why. Last year I didn't have any. The year before that I had a few. But I think it's become less and less common as people realize it's not as easy as it sounds. And any client that I've had do that will come back to me and say, I don't think I'll ever do it again, because they usually have another full-time job and they're trying to manage a construction project. And they want, well, you see it every day and you hear Todd talk about, like, you need to be on site, you need to see what's happening, you need to oversee, you need to coordinate, like you're the best wedding planner in the world, that, this tradesperson is there before this tradesperson can do that. So it's a lot of work.
Yeah.
And if people think they're going to save money by doing that, you're really not. Yeah, you're not, because you're taking away from whatever your primary job is.
Yeah. Plus, they often end up paying more.
Absolutely. Yeah. Well, they don't have the benefit of doing many projects where the sub-trade person will, if Todd calls, they're going to be there because they're going to know there's going to be more business in the future for them. But if I call and say, I need you to, come and put my electrical in, they're like, I'm way down on the list of someone's priority for them to come and do that work for me. So I think over the years, it's become less and less common as people realize that.
Yeah, I was just curious how many were. Yeah, it's interesting.
Yeah, a friend of mine, he's like a licensed electrician. He built his own house, contracted himself, was lucky enough to be able to have all the reserve fund and all that he needed. And he said
Yeah.
it was 8 months of hell. He would say he would never do it again. Pay the contractor.
Yeah. Especially right now in our market. I mean, construction is booming. So tradespeople are and it's hard to get. So you need to be their priority. I'm just going to talk quickly a little bit about benefits, because some benefits of doing turnkey construction versus buying land and building with a builder. And Janice is very familiar with this. We had a mutual client last year, and so there's two sides to this. If your client wants a new home, turnkey can be the quickest, easiest. If they don't have a way to buy the land up front, then I would suggest turnkey. But with a turnkey construction mortgage, they are going to be paying deed transfer tax on the full purchase price. So if their full purchase price is $400,000 in HRM, my mental math is not good this morning, that's $6,000 in deed transfer tax, because it's 1.5% here in HRM for the PEI guys there. So they would be paying that on closing, just like buying a resale home. If a client is able to buy their land first, they're paying deed transfer tax on the land, but not on the finished product. So it can save them a little bit of money there. So if their land was $80,000, 1.5%, it's $1,200. So there's, a $4,800 savings there in deed transfer tax. The other savings, but you have to be careful with this, but the other savings can be that your costs can be a little bit lower if you're able to buy the land first, because the builder doesn't have to carry the cost of building the home for you. So in a turnkey construction mortgage, the builder is buying the supplies, they're building the home, they've got lines of credit, they're using their own assets, and it could be 4 months, 6 months, 8 months for the home to be built, and they're not getting paid, and they're paying interest on that money. So they're going to be building that into the cost that they'll be passing on to the client. If you have a builder, like I know Todd has explained this to his clients, and it makes perfect sense. If the builder does not have to carry all of that, and they're building and getting paid and building and getting paid, my hands are moving the opposite direction. So they're building and getting paid so much and building and getting paid so much, then maybe they're not paying interest on their lines of credit to carry all of that. So it's costing less to build the home, and they will often pass that on to the client. So that can be a benefit. Any questions for me so far?
I just got a quick question.
Yeah.
Do the buyers have to pay for an inspection on each draw?
So the appraisal, we need an appraisal up front, and we can do up to 5 more reports. So that's a total of 5 appraisals. So yes, there is a cost for construction mortgages. It's an overall cost of $700. It's a one-time cost for clients that want to do a construction draw mortgage. Which, an appraisal can be $400 or $500 each time, so it's not bad.
So, Darlene, is that built into the mortgage? Is that paid up front? No. Is it paid on closing?
It's paid with the first draw, usually, Chad.
Okay.
Yeah, just the same as, there are costs for a regular appraisal. You're buying a resale home. If your mortgage is not CMHC insured, and the bank needs an appraisal, or we're getting a valuation on that property, there's usually a $300 cost for that. And that's for one appraisal. So, to do 5 more draws, it's not that much more. It's $700.
Okay. Now, going back to the mechanics lien holdback of 10%.
Yeah.
Okay. When you're doing draws, they take 10% off each of the draws. However, a lot of the builders are actually buying into the new home warranty programs, where the warranty program will guarantee the mechanic lien holdback. So is that still a mandatory thing?
I believe it is, but you could ask the lawyer if they have to hold it back. But my understanding is they still have to hold back 10%.
regardless if the mechanic it's the new home warranty. Because I know the Lux new home warranty has different levels of coverage, and one of them is deposit protection, and they guarantee the mechanic lien holdback. So.
Yeah, I've never heard of it not being needed, Chad. And when you say the Lux home warranty, because that warranty is usually for the client, are you talking about the warranty to the builder? Well,
the Lux home warranty is there are different levels of warranty coverage. So it does cover the client, of course, for deficiencies after the closing. But right. there are little perks or privileges within that will also help the client. So in this case, I see it being a benefit if they didn't have to hold back that extra 10%, because if the mechanic's lien holdback is guaranteed by the warranty program, and there does happen to be a problem, the warranty program will pay out the mechanic lien.
Yeah, you could have that conversation with the lawyer, because it's the lawyer's obligation to hold it back based on what the provincial legislation is. So maybe if he felt comfortable that warranty covered it, he or she, then maybe they wouldn't have to.
Okay, fair enough. And now you also made a mention about when you're doing construction draws about having a warranty program in place. Is that mandatory with the bank?
Yes, you need a new home warranty. It's actually mandatory in all provinces, I think, except Nova Scotia. But if you want a mortgage on the property, unless it's a self-build, then of course you don't need one. But yes, you need to have a new home warranty.
Okay, so that was going to be my second question, is if you're going through a general contractor, a reputable builder, the bank will require a new home warranty in place. But on a self-build where I see a higher risk, you're saying they won't require one?
Well, no, because you don't have a builder to have the warranty.
Wow. So there's no,
yeah, there is no warranty because, they have to have insurance and all of those good things, but they're being their own GC and managing the sub-trades. So it's a little more risky for sure with the self-build, which is why it's a little bit harder to get approval for.
Right on. Okay, that's great.
Yeah.
Thank you, darling.
Good questions. Anyone else have any questions they want to ask?
Line of credit. I guess it would depend on the strength of the borrower.
Absolutely. Yeah.
So unsecured or secured, it all depends. If there's security, they'll take it. If not, then it depends on the strength of the borrower. Is that right? Yeah,
but it's usually an unsecured line of credit for land. That's normally how people, so they do definitely need, the scenarios that I can say that work well for someone, because, if the land you want to buy is $250,000, you need to have good income to make that work. There are various land loans that we can do as well. But usually people are selling a home and have the equity to buy the land. And then that land is their down payment. And then we do the construction mortgage from there. That scenario works really well. Or they own a home, let's say even free and clear, or with a very small mortgage on it. They have enough equity on their existing home. Then we can do a secured line of credit on their existing home to give them the funds to buy the land. That scenario also works very well. First-time home buyers, if they have good income, can make it work by, let's say, they have $20,000 saved for a down payment, but the land is $80,000. Then they could get a line of credit for $50,000, and they have, $20,000, $30,000, say, in savings. They could buy the land. We can still show that, they had $20,000, that was their down payment. And then we can pay off that line of credit within the draw system by going to 95% of the overall value.
Right. Okay. Yeah. You took the next question away from me. So no, that's fantastic. Yeah. So simultaneously, you pay down the line of credit that you offset your debt ratios that way.
Yeah. So for example, I wish I had like a whiteboard or something I could write on here for you. But if you kind of have a pen and paper there, like if you start with a $400,000 value and a 5% down payment would be $20,000. So everyone has to have that. And then the overall mortgage would be $380,000. So if you go back to the value, and let's say the cost of construction was 320, and the client needed 80,000 to buy the land, then, and they had 20 or 30,000 of their own savings to buy the land, they got a line of credit for the difference, the 50 or 60,000. That allows them to buy the land. They had their own equity for part of the land, so that's their 5% down payment. And then if you do 95% loan to value on a $400,000 overall value, that gives you 380 to work with. Your construction costs are 320, so you've got the 60,000 left over to pay back the line of credit.
Right on. Yeah.
But there's really not a scenario where you can go into this without having any of your own resources.
Right, minimum of 5%.
Minimum, yeah, and you need good income to make that scenario work, because you need to be qualified for the line of credit. And if the line of credit, we also need to be able to work that line of credit into your debt service ratio.
Yeah.
Yeah.
So with every draw, do they make payment toward the line of credit?
It just depends on how the draws are divvied up, but usually the line of credit has to be paid out in the first straight. It depends. If the debt service ratio is too high with the full line of credit in their debt service ratio, then we say the line of credit will be paid out in the first draw so that we don't have to add in that line of credit. Okay. And that becomes like a condition of the mortgage. But if they have really good income, their debt service ratio is fine, then it can work a bit differently.
Okay, so that arrangement is discovered on the onset of the process, so that the builder is aware they're not going to get the full first draw amount.
Yeah, the builder is never going to have an exact amount of what they're going to get with the first draw, because we don't know that until we get the appraisal report back from the appraiser.
Right. Okay, fair enough.
So yeah, so most builders need to, most are aware if they've built homes and they know how bank financing works. There's no bank out there that does it and says, oh, your builder wants 80,000, we'll give you 80,000. It has to be based on what the appraiser is saying. It used to be the percentage completion on the home. They flipped it a few years ago, because what was happening on some larger construction builds is people were overspending a little bit, and then they were running short on the last draw. So now they kind of back end load it, because the bank, the client, the builder, everyone wants to make sure that home gets built. So the calculation now is your mortgage amount less anything we've advanced, less your cost to complete the home. So every report that the appraiser sends in out of those 5 draws, they have to indicate a number for us that says what's your estimated cost to complete the home, and we always have to hold that back.
Right.
Yeah. So any situation that I've ever, been in, and it's usually with higher value homes, like we had an $80,000 shortfall once. It was it was probably a $700,000 build, so not a lot comparatively. But the appraiser went out, we did the calculation. It was going to be 80,000 short for what the builder wanted for payment. So I just called the builder and said, what are you doing right now? Well, we're drywalling. That's going to be done in 3. Okay, so if we wait a week and do another inspection report, that could make up the difference of 50, 60,000. So the fact that we have the 5 draws allows a lot of flexibility for that. It was a bit trickier when there was only 4.
Right, so you can juggle it a little better.
Yeah, or you speed things up and say, well, okay, we'll get the builder to get this done or get the electrical and plumbing in, and then next week we'll send someone out again, and that can activate additional funds going out. At the end of the day, if you're approved for 320, you will get the 320. It just may be not always on the same schedule as when, like I say, most contracts I see lately, the builder's just taking the overall price, dividing it by 4 and saying, here are the payments that I want.
Right.
Yeah. Yeah, but I think most builders will work with clients, to wait for that if it's $10,000 or $20,000 short. But the client needs to understand and have that conversation with the builder. And if the builder says no, like I want my payments on these dates, they need to make sure they have a good line of credit in place for any shortfalls.
Okay, so last question, and then I'll get off the stage here for a minute. But I got. So talk to me about the down payment assistance program that you can use for turnkey, but you cannot for draws, from my understanding.
The Nova Scotia Down Payment Assistance Program?
There's a federal one as well, from what I understand.
Okay, well, they work very differently. So the Nova Scotia Down Payment Assistance Program is really to help people that earn under a certain amount of income, and the maximum purchase price in HRM, I believe, is 280.
I think.
Yeah. Yeah. So it doesn't often come into play with a construction draw mortgage because of that limitation. I would have to check. I don't actually know off the top of my head if it's applicable for construction draw mortgages. And the federal government program, the First Time Home Buyer Incentive Program, is where the client can borrow money from the federal government. If it's a new construction home, up to 10%. If it's a resale home, up to 5%.
Right.
Yeah.
Okay, so my guy was not eligible because I just did this with clients who are borrowing through the federal government. I think there's a 15-year repayment program with them.
No, there's not actually, Chad. It only gets repaid when the home sells. It has to be repaid. That triggers the sale, or 25 years, just as an effect. Yeah.
Okay, perfect. Yes, exactly right. So yes, he was not able to do because he was exercising that option with the federal government down payment program, and he was not eligible to do it through mortgage draws, for whatever reason. I'm not sure why they would not consider.
So they told him the reason he was not eligible is because it was a progress draw?
Yes.
Okay, I'll look into that. There are other criteria, like regarding his income and the size of the mortgage. Was it a pretty substantial mortgage?
I think they're going to be into it for around $340,000.
Okay, because there's kind of a rule where it can't be any more than 4 or 5 times your income and a few things like that. But I will ask about the construction draw mortgage with that program.
Yeah, because honestly, the way I was trying to work the contract is obviously, I think it would have been better for them because I would have liked to seen them close on the lot first because it was not a real pricey lot, but the contract agreement with the builder was fairly substantial, and that they are going to save. And it was pretty much in line with the numbers that you were using. It's a $6,000 de-transfer cost, where if you eliminate that, they would pretty much save close to $5,000 for de-transfer. It was like $1,200, so $4,800, almost exactly what your example was earlier. So they would have saved $4,800 if they could have gone.
Yeah, and now one thing I'll say about that program, Chad, it's a good program in certain scenarios, but if you're borrowing 10% from the federal government, or 5% if it's a resale home, 10% if it's new, when you pay that back, you're paying back 5 or 10% of whatever the new value of your home is.
Right.
And one thing we all know about new construction is the value typically goes up pretty fast, right?
Yep.
So, if they borrow 10% of $400,000, it's $40,000. But if they pay it back 10% of $500,000, they're paying back $50,000. So there's a cost of $10,000 in there. That they just need to be prepared for.
Right, absolutely.
Yeah, and I think that program makes a lot of sense when interest rates are 4 or 5%. But when interest rates are under 2%, and I've done the math on it a bit, it's maybe not always the best option for the client.
Right.
If they feel the value of their home is going to go up quickly.
Right. So
because they still need their down payment. It's just they're borrowing a little bit less from the bank and they're borrowing it from the federal government.
Right. So they did offset it a little bit because they're taking 5% out of their own RRSPs, and then they're only doing 5% from the federal government program. So they don't have, the federal government doesn't have as much as invested, and they're not going to get as much return. Hopefully their value will continue to go up, but in 10 years, who knows, 15 years.
Well, and the other thing is that they have the ability, they can pay it back before they really feel the value is going to go up. But in my experience, people aren't always going to have that $10,000, $20,000 just to pay back like that.
Right.
Yeah. And we, in our business, we're going to have to be a little more diligent over the next 5, 10 years when people are selling their home and checking to see if there's that second mortgage property. Because I know clients are going to forget they did that loan. I have one doing it now on a mini home, and I keep going through it with her, and she keeps saying, "Oh, what's that program again?" I'm like, "That's the program that you applied to, that you wanted to borrow the money from the federal government." So I'm thinking, in 5 years, when she goes to sell her mini home, is she going to remember that she did this? So you guys are going to be looking at property online. I'm going to be looking, you know, if I'm trying to find it.
That's what I was going to say. It has to be registered somewhere that we'd be able to see that that's happening, right? Okay.
Yeah, it would show as a mortgage calling on property online. It's literally like a second mortgage.
Right. Okay.
Yeah.
Yeah, because that's going to affect the equity that they're going to have coming out of the house, right? So then we're going to have to be figuring out, okay, is there enough? Are they going to come out even ahead, let alone finances to pay who needs to be paid?
Right. Because it's not like with their mortgage where they're always in their online banking and they know what they owe on it.
Right.
I don't know yet because it's so new. I don't know if they get yearly statements or if they have to call in. Pardon me, they wouldn't get statements because the amount's just going to stay the same. It's just a matter of, because interest isn't accruing or anything. And they don't make regular payments on it. They only pay it back when they sell or reach 25 years.
So there's been no word, Darlene, on being able to pay that out early, is there?
You can pay it out early.
Okay.
Yeah, you can. They have they are allowed to ask for an appraisal, which the client has to pay for. Yeah.
So if it doesn't increase in value, is there a payout penalty?
There's not a penalty, no. So if they bought for 400 and when they sell it's 410 and they borrow 5%, they're paying back 5% of what the new value is determined to be by the appraisal that might be required.
Interesting. Okay.
Yeah.
Excellent. Okay, so if you can just let me know why they wouldn't be able to do a draw mortgage, I would really appreciate that, because my client was trying to interpret that for me, and I'm not sure he had it right, but.
Yeah, I will admit it's not very well explained. My mini home client, I've had to give her more numbers to call because it's not us that they're borrowing the money from. Her insurance letter had to indicate CMHC was the second payee. She needed their address. She kept coming back to me and I was getting her all of the answers. But yeah, so it's easy for clients not to really have a good understanding of that program, but I will find out, Chad, if construction draw mortgages are eligible for that program and get back to you.
Right. Perfect. I really appreciate that.
So we've got a few minutes left. It's about 10 to 11. I think we have it scheduled till 11. Any other scenarios you want to chat about?
I don't think. I know it's good to have this knowledge because I have a handful of people who argue with me about how the draw mortgage works and think that just because they know how to swing a hammer, they can build their own house. So.
That, Alex, I would say that's one of the most common conversations I have, and often with first-time home buyers where they think they're handy. I'm sure they're handy. I'm not saying they're not, but they think, they can save some money by doing it that way. Yeah. And as I said, it can be, it can be a little more difficult to qualify unless you have good assets, good income, some lines of credit available to use, that type of thing.
Yeah.
Yeah. I think I've covered everything I wanted you guys to know. We talked about overruns. We talked about mechanics lien holdback, 5 draws. They pay interest only during the construction draw stage. Yeah, and I guess really for you guys, do you get involved a lot in the details if they're meeting with the builder, or do you kind of help them with the land and back out of it then as a realtor?
So for me, it all depends on the needs of the client. I mean, we had to research the best case scenario financially for my buyer client. You know, we originally thought maybe going with the closing on the lot because they had the resources to close on the lot because they were going to use their RRSP money first, could close on the lot at that point, and they'd do a builder mortgage, or construction mortgage. But unfortunately, they were going through the federal down payment program, so for some reason they were not qualified. But yeah, I mean, you have to look at the big scope of it and their ability to finance the final product. So, you know, you have to really factor it in. Now, you know, I don't usually go back in the day. We definitely went into the finer details of the calculations and the best case scenario. But that was usually when the banks were open 9 to 5 and there were no floating mortgage specialists. But now the mortgage specialists are available more often through the day, the night, and the weekend, that we kind of pawn off the responsibility to crunch the numbers to the ones that are experienced, especially in new construction. So, you know, so far that I will go. And then sometimes I just like, okay, maybe this is not, you know, maybe I don't have the depth that the mortgage specialist has. So I'm going to bow out at this point, put you in touch with them. And the other thing is the policies change so quickly and so often that it's hard to keep up with them. So, I mean, you guys, you got your finger on the pulse when it comes to the changes, and we're just kind of hoping and relying on you guys to pass that information along for us to interpret to our clients. So I think sometimes it's better for us to stay out of it and let you do what you do best.
Yeah, that's well said, Chad. No, it's very true. I mean, sometimes I can't even keep up with all the changes. We had big changes this summer in our construction policy, all for the better. But every client scenario is different. So, you know, I do get clients that'll come to me and say, well, my realtor really, you know, is pushing me to do this because I'll save transfer tax. But what the realtor may not realize is, but the client may not qualify for a construction mortgage because of their income. If their debt service ratio is going to be really tight, then turnkey is often the way they have to go if they can't show that they can afford some of those overages and whatnot. Yeah. And some clients don't even want the headache of, well, I owe my builder $80,000 and we'll give you a draw of 56 and I have to take the rest out of a line of credit. They don't even want to think about it. They just want to have their mortgage advanced on closing. So it really is dependent on every individual. You know, there might be slight differences amongst each bank. So as well, Chad, you know, good point. You're the expert on real estate, but maybe not on how that mortgage is going to work. So just make sure that the client has had good conversations with the bank that they're using, and that it's well explained.
Yeah, for sure.
That's the key. I had a client last year that built a beautiful home in Indigo Shores with another bank. And there were so many things along the way that they were not told, that they waited for their last draw to advance. They came in and said, we want to move our mortgage. They paid a $6,000 penalty because it was a new term. She said, I don't care. They were just so frustrated with the process because no one was communicating with them or letting them know that. So I like to give every kind of, I'll say, worst case scenario up front. So there's never anyone that would say, oh, I didn't know that could happen, or I didn't know that might happen, or I didn't know I had to use some of my own money. They need to know that. And then it's a good experience for everyone.
Yep. And in fairness, if you're in the real estate business, you're a lawyer, or you're a lender or a mortgage specialist, you should be upfront and honest about your ability to help the needs of that particular client. Even in the banking world, not every mortgage specialist knows new construction and the ins and outs and intricacies of it, right? A lot of what I discovered is a lot of the branches on the peninsula of Halifax don't do a lot of construction mortgages.
No.
Right? Go to Clayton, you can bet on the fact, or in Bedford, bet on the fact that the mortgage specialist you're dealing with is very familiar with new construction.
Yeah, and I would also advise, if your client is working with a branch financial advisor, they're not well versed on construction mortgages. At RBC, and I'm not doing this to plug RBC, but just so you guys understand the difference, at RBC, if a client comes in and talks to a financial advisor, that financial advisor is encouraged to put them in front of a mortgage specialist right away, because it's going to be a better, more seamless experience. The other banks work differently. They have mortgage specialist advisors with other banks, but the branch staff, they don't always refer all of their referrals to those specialists. So sometimes they try to do it themselves. And I think that that's when people can run into trouble because they're not getting the advice that they need.
all of the information up front, like you were saying, and then all of a sudden they were like, oh, I didn't know to explain that, and here we are at that crossroad.
Right. Yeah.
The other thing I want to point out is the fact that not every builder is capable of doing a turnkey package. So it's unfortunate, but you might run into a situation where you want a certain builder to build the house, but they'll insist in doing the draws because they don't have the financial resources to be able to do a turnkey package.
Yep. It's true. Yeah.
So that kind of gives the advantages to the more wealthy and bigger builders because they can hold that debt until closing, where a lot of smaller builders trying to make their way in this world, they don't have the financial resources. So.
Yeah, and I guess that's why you see the bigger builders in the new subdivisions, they own all the lots, and because they're just doing they're doing the turnkey builds versus, the individual builds.
Yeah, absolutely. So.
Yeah. Well, if you do have any questions, guys, feel free to reach out. I will, I do have a bit of a handout that I'll share with you. And actually, you know what? Is it here? Am I sharing my screen now?
No.
Not yet. Okay.
Alex needs to give you the ability to do everything.
Oh, okay. No, you know what? Here.
Hold with me for a minute.
I think I'm sharing. I think I'm sharing now. Am I?
Yeah.
There. Okay. Yeah. So I'll send this to Aaron. It is a handout that I can share with you that we give to clients. And it's a little involved for a client to read, but it just, talks about things getting started, what they need to think of, look at, cost to consider. Sometimes people forget about site clearing, landscaping, all of that. Gives them a bit of an example of how draws would work and how financing works. And then there's a bit of a worksheet where they can start plugging in numbers. Again, they shouldn't use it to try to self-pre-approve themselves, but it does give them a little bit of a worksheet. And sometimes right away, people will look at this and say, yeah, that's probably not going to work for me. So I will, or yes, maybe this will work for me. So I will send that to Erin and she can send it out to you guys.
One last question before you go, Darlene. I just thought of it. Occupancy permits. Do they have to be? Do you need an occupancy permit or just the final inspection report?
I think the lawyer needs the occupancy permit before the final draw. We need building permits, obviously, but I think the timing, that's something the lawyer normally handles, Chad, but I think it's before the final draw because then the client can move in and occupy the home.
Okay, yeah, for sure.
Yeah.
There are some times where a builder can't issue an unconditional occupancy permit, and I'm sure the banks are fine with that because your final grading plan has to be done. And if you close in like February or March and that landscaping can't be done and the final grading can't be completed, there might be a holdback or there might be an unconditional or a condition on the occupancy permit that certain work has to be done before it can be unconditional. So I'm sure the banks can overlook that.
I've seen that. Yeah, I have seen that where there's been some holdbacks for landscaping due to the time of year.
Right.
Yeah.
Okay. I'm all good.
Thank you so much, guys. Very interactive. I like that.
Absolutely. Thank you a lot.
Thank you.
Thank you so much.
Great info.
Yeah, thanks.
Great info.
My pleasure.
Thank you.
Take care, everybody.
Have
a great day,
guys.
Okay. Talk